Okay, good afternoon and welcome back everyone to another episode of Options Education with Jessica Inskip, our Director of Education and Product, and myself, Tony Zhang, Chief Strategy Officer here at OptionsPlay. So Jessica, welcome back.
Thank you for having me, Tony, as usual.
Today we have a very interesting and in-depth discussion around option strategies during bear markets. And I wanted to discuss this session because I think for investing and trading, things are always relatively easy when things are going up. When we're in a bull market, things get really dicey in a bear market, not only from a strategy perspective, but also from an emotional perspective. And far more probably challenging is that emotional aspect of things. So today we want to talk about both. We want to talk about how does your trading psychology change during a bear market? How do you adjust for that, and type of option strategies that you can deploy, whether you are an equity investor, whether you are a trader, whether you're a tactical trader or strategic trader, swing trader, day trader, whatever that is, how you can use option strategies to potentially take advantage of the current market volatility when you see when we're in a bear market. And I see many of you have joined us here during today's session. So please, everyone, give a quick shout out in the chat window, who you are, where you're from, and also let us know if this is your first time joining us on a session, or if you've been watching a lot of sessions with Jessica and I in the past. But while you do that, let's go through some housekeeping. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. So let's kick this off, Jessica, by taking a look at walk down history. I would say that you're kind of the OptionsPlay historian at this point, based on the things that you've researched and looking at the past. And you have some information that you want to share with us by looking at the markets over the past roughly 100 years. And some of the things that we can learn from that in terms of bear markets and how you should be thinking during this period of higher volatility and how that affects investors from an emotional perspective.
Yeah, absolutely. And I do find it so funny that I ended up being the OptionsPlay historian. That was my least favorite class of all time, as I hated history. So maybe if there was just history of the markets, that would have been fine. Nonetheless, so rule number one when trading in general, but especially when you're heading into a bear market, especially if it's something you've never done before, is your trading mindset. So that's what we want to start with. And if you've been attending these sessions before, you've noticed that Tony and I both did a session on our view on trading mindset and what helps you be profitable. And a portion that I pulled from the presentation that I gave a few weeks ago is the cost of your mindset. And so what that is one, this is in the perception of entering into the market for the first time from just being an investor overall, so not necessarily trading the bear market. But the perception is if you enter into the market at any times where this chart says a mistake, that seemed like a peak at the time, in which case you would have lost a ton of money if you just started trading. But in the long run, you would have made out very, very well. And that's the cost of mindset, and that's emotional investing. So what's important to understand when you are trading in general, and it's especially heightened with options, is not only is the cost or the risk your money that you're investing, but you also have to accept volatility as well. And options are extremely a great product to capitalize on that volatility, but you can also profit from various market conditions. You can reduce your cost basis. So a lot of people talk about dollar cost averaging in these type of markets. There's ways that we can utilize options to even maximize that. So what's important in trading in general, heightened with options, is those calm, collected, calculated decisions. So we want to start this with trade mindset, and to know that you have to be in the right headspace when you start trading, heightened when it's options, and even more so when you're trading a bear market, especially if it's your first time. And we haven't had a true bear market like this, and the longevity of it anyways, for quite some time. So it's important to bring this first and foremost front of mind before we get into the strategies.
Yeah, that's absolutely right. And studying history from a financial markets perspective is really important because when you look at the big picture, there are a lot of very interesting statistics around success of investing, success of trading, and most of them actually come around bear markets. Most of the returns that you can expect over the past 10-15 years from investing comes from sticking with continuing to invest during bear markets. A lot of I would say trading and just psychology of money in general tends to be quite counterintuitive. We all know the old adage of buy low, sell high. Yet we as human beings rarely do that. We typically do a lot of our buying towards the market tops. When we hear all of our friends and all our family is jumping in there, everyone's investing, we feel that we don't want to get left out. We tend to buy at the highs, hoping that things will get higher. And when things are really bad and we hear everyone else is in pain, that's really when we tend to sell and get out of the markets, when in reality, that's actually the worst times to get out of the markets and the worst times in theory to invest. So there's a lot of interesting things that you can learn about the markets that is very counterintuitive, but really that's what's so important about studying history, is understanding that when bear markets happen, that's when it's most painful. Those are some of where the best opportunities come from. So, really, really important to understand psychology and how things change, because it's one thing to say, okay, here are some option strategies that you can take when markets are turning bearish, but it's important to first address that when markets are bearish, this is when most investors are scared. They're not willing to pull the trigger on some of the things that we're going to discuss. So it's really, really important to understand your mindset, understand how that changes during a bear market before you think about some of the strategies. So let's jump into some of the strategies that you can deploy during a bear market. And I just want to, before we jump in, just say a huge thank you to everyone that's joined here. And I've seen many of you respond in the chat window from all of the different parts of the world that you've joined us from. So first of all, welcome. I hope for those of you that are here with us for the first or second time that this is helpful for you and you'll come back next week. But we are really excited to talk about a little bit in this current market condition, what do you use? So we're going to talk about three different strategies. We're going to talk about hedging, meaning for those of you that are just equity investors, maybe you don't consider yourself an options trader. You don't think of yourself much as a trader. You're mostly a long-term investor. How can you use options in a bear market to potentially protect your portfolio so that you suffer a little less downside than if you were just to stay invested in the broader markets, and perhaps have a little bit more confidence or a little bit more capital to keep investing as markets turn south? Because as things turn south, that is your opportunity to buy low. When we talk about buy low, sell high, it's only in bear markets do you have that opportunity of buying low. So it's all about how do you keep the confidence, how do you protect your capital so that you have the ability to continue buying as things start to go south. Then we'll talk about a directional strategy, meaning you have a stock, you have an ETF, you have an industry that you think is going to go lower during this bear market. How do you potentially profit from that? This is purely more speculative. This is on the trading aspect of things. That's really where we want to take a directional view and try to profit from that. We'll talk about the option strategies you can use there. And lastly, talk about income, because this is really where, as volatility rises when markets fall, that volatility can be used to be harvested. And this is really the only place that options allow you to do that. When things get volatile, you can collect more income. So we'll talk about different ways that you can do that in a bear market, where you're going to collect more income during a bear market than you do during a bull market. So those are the three different strategies we're going to go over. So let's take a look at a specific stock. Now, in this particular case, we're going to use a stock that currently has been one of the strongest stocks in the industry, but is starting to show some signs of weakness. And I think there's a lot of investors that may currently feel that markets are going to turn lower. Some of you may not agree, but this is really more of a lesson, not necessarily from a timing perspective, but from a if and when you feel markets are going to turn lower, or the stocks that you own in your portfolio is going to turn lower, how do you deploy strategies in your portfolio that allow you to protect it and potentially profit from this bear market? So let's take a look at the security in mind.
Yep.
I'm pulling. Sorry.
I was going to say, before we jumped into that, if you're okay with that, last week when we mention that we were going into those strategies specifically, someone asked if we can just cover the basics real quick. So I wanted to make sure that we accounted for that as we said we would. So before we go into the strategies specifically, just know that everything is an extension. And this is a T-chart that we teach through the essentials. So our courses that we have earlier on, and you can find them on our YouTube channel and on our website as well. But you might see this quite often, and it's just a good way to visualize how each individual leg works. So we're going to focus on, we say strategy drivers quite a bit, short calls and long puts, because those are bearish, and that's where they're found on this quadrant, is they are individually bearish. And what we say, and we allude to when we talk to when we go through those essentials of options pricing and understanding calls and puts, is that understanding each individual leg is key for a solid foundation. And you can actually utilize each individual leg for either capping potential gains or mitigating risk. So that's what we're going to talk through. But I wanted to make sure that you were fully aware of that. Short calls are sold. That's going to be your primary driver for anything that's capitalizing income. We want high implied volatility. Time works against us, and it's a neutral, and you also profit from downward movement. Where long puts in that directional side and also utilized for hedging, time decay is working against you rather than for you. And this is where we want that profit of sharp profit. And then we can utilize the other two just to cap any downwards movement, so our max profit potential, or mitigate risk. And we'll go into that in a little more detail. Thank you for letting me interrupt you, Tony.
No, please do. And when we refer, and you're going to hear us talk about the term strategy driver quite a bit during today's session. What we mean by this is that when we're trading what we call complex options, where we're mingling long calls, long puts, short calls, short puts, there's always a key part of that strategy, meaning the primary reason that we're selling or buying that either put or selling that call option. And that's what we call as a strategy driver. There's a secondary part of each complex strategy that provides certain things. And usually that's either risk reduction or risk reduction is predominantly the reason that you add a second leg to an overall strategy. So we'll break down each one when we go through each strategy. So but for those of you that are newer to options, or especially if you're newer to complex options, the most important thing is to learn these four foundational elements, because all complex strategies are built on these four foundational strategies. Everything else is going to, you can break them down into these four core components. As long as you understand these four core components, you'll be able to understand any complex strategy. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. And so once again, Jess, thank you for interrupting me and inserting this slide, because I do think it's really important before we jump into the strategies we're going to discuss here today. So let's fast forward now to that stock that I was referring to. This particular chart that you're looking at, I can just outright tell you the stock that we have here as an example is United Health. And I'm using United Health because this has been one of the stocks that for the past three decades roughly has been one of the best performing stocks in the S&P 500, meaning it's outpaced pretty much most of the tech stocks. It's outpaced the S&P 500 by a very, very large margin. So why am I looking at this as a bearish opportunity? Well, there seems to be certain cracks that are starting to form. Recently, it formed this double top at that 540. You see the double top that are recently formed? That's at the 540 level. But more importantly, the relative performance of this stock to the sector, which is the healthcare sector, has started to drag lower. And this is this underperformance in the very beginning that shows me that potentially this double top is a top here for United Health. Now, I'm only using this as an example. This is not a recommendation to short United Health, but I want to show you, if you own this stock in your portfolio, you might be very inclined to hold onto your stock. And that's why I love using this as an example, because this is a stock that has performed for the last 30 years. Markets are down 18, 19%. You're unlikely to let go of this particular stock because it's still outperforming the rest of the stocks in the market. But you might be concerned of a pullback. And that's really where some of these particular strategies that we're going to discuss is going to be useful. So what we'll talk about here is a collar strategy. And what you're trying to do in the collar strategy is buy protection in the broader markets, or buy protection in this particular stock, but use the elevated implied volatility that we currently have in order to do so. So let's say you own the stock at $520. Now, most likely, if you own this stock in your portfolio, you own it at a lower cost basis. But let's say you went out there and you bought the stock recently, a few months ago at 520. How can you protect this investment if you want to remain invested? So the first thing that you might want to do is outright buy a put option. So we're looking at going out to the November expiration, buying a 510 put. That's going to cost you about $12.50. That's about 3-4% of the underlying stock's value. So you're paying 3-4% to protect your position over the next couple of months. Now, that's not cheap, especially given the market environment that we're in. So this is really where we turn to a collar strategy. And this is really where we're marrying two parts or two different option strategies that allow you to do or accomplish a similar outcome for a smaller cost. So here what I'm doing is I'm buying the 510 puts. That's going to buy me downside protection. So as the stock drops, whatever I lose in the underlying stock, I'm going to gain back on the put option. But because the put option costs $12.50, what I'm going to do is I'm going to sell a 540 call against it. I'm selling it at the near all-time highs of this underlying stock. We have a double top at that 540. I'm concerned that there's not enough momentum or not enough accumulation to push the stock back above 540. So what I'm doing is I'm selling away any capital appreciation above 540 in exchange for about $12.10. That's roughly the cost that it cost me to buy the protection. So what I'm doing is I'm trading off further upside because I'm concerned that stocks are going to move lower from here. I'm not too worried that there's going to be a lot more upside I'm losing out on. And what I'm going to be able to do is take that premium and buy the protection that I need. This is what we call a collar. And I happen to have found a collar that is very close to zero cost. It's not always that you're going to be able to find a zero cost collar. And I don't necessarily think that your goal should be always to seek a zero cost collar, but to think about the cover call as a way to offset some of the cost of buying that put option. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And Jess, you've been a very big proponent of this strategy over the past 2 months or so since we've been doing these market playbooks. Tell us a little bit about kind of what you love about collar strategies in your portfolio.
Yeah, it's if you have those longer term securities that you still want to hold. So if you I tend to find sometimes I'll have two outlooks on a security, which is interesting to say. So let me explain that a little more. Your short-term outlook, as far as from a trading perspective, I feel that it's going to hit this resistance or support zone, and in the short term may go one direction, so perhaps down, but long term, I may feel it's going to go another, in which case I may not want to give up the stock just yet. But the collar strategy is something that's really helpful when I do have those long-term and short-term views, because timing can be impeccably hard. But when you implement something like the collar strategy, you are literally putting something on either side like a collar, hence the name. So I like the fact that if it still moves up with my long-term view, I can sell it at that higher price, but I'm also protected on the downward side, which makes me feel comfortable still owning that security, if you will, because it does require a lot of capital just to own a stock, especially something that's $520 per share.
Yeah. So Matt is asking a great question and Peter's asking a great question. I just want to address those really quick before we move on. Matt's asking, don't you need to own 100 shares in order to deploy the strategy? And he's absolutely right. This is a strategy that's only applicable if you own at least 100 shares, because you can't sell that call option unless you own 100 shares. You can do it naked, but I don't recommend it, and you're taking on an excessive amount of risk to do so. So Matt, you're absolutely right. The second question Peter's asking is, how do you select the call strike? Do you base it on premium, or do you base it based on probability? And this is really where, from my perspective, it's actually neither. I prefer to use, in this particular case, when I'm using a collar, I prefer to use technical levels, resistance levels to select my call strikes. And that's particularly why I use the 540 strike, because it's a strike very near the all-time highs. I don't think it's going to get pushed significantly above this double top. If it does, then I would certainly get rid of my collar and remain long on the stock. But this is really where I would prefer to use more of a technical level rather than either premium or probability. So hopefully that addresses your question. Let's move on to the second strategy. Okay, this is for if you own the stock and you want to protect it. But many times in a bear market, you don't own the stock. You just find opportunities of stocks that you think is going to head lower. And certainly United Health, from my perspective, fits that bill. Valuation wise, it's on the higher end. Technically speaking, you're starting to see some cracks in the charts. It's really early days, but perhaps the risk to reward in this particular case seems quite favorable. We're looking at a potential drop of, at least $50, $60 with only about $20 worth of risk to the upside. If it goes back above 540, I would say we're no longer bearish on this particular stock, but I do think this could pull back well into the high 400s. So the risk to reward certainly makes sense. So if you want to be a tactical, speculative player in this particular type of environment, bear market certainly provides you with many times what could be quick, violent moves to the downside. And that's really where a put debit spread allows you to take on these types of tactical opportunities and do so in a way with the least amount of risk possible. So here what I'm doing is I'm going to buy a slightly out of the money put option, buying that 530 put, and I'm going to sell a 470 put against it. Now, why do I do that? It's really because to outright buy the 530 put, which would give me unlimited downside opportunity, it's going to cost me $20 on a $500 stock. That's about 4%, a little over 4%. Now that's quite a bit in order to buy a put. But if I sold the 470 put, I can collect $4.50. That's basically reducing my overall risk on the trade by about 20%. Instead of paying $20, a little over $20 for the put, I'm only going to pay in this particular case about $16. So I'm reducing my risk by 20%. Plus, I don't think that the stock is going to zero between now and the expiration date, which in this particular case is November. So I might as well risk $16 versus $20. So this is really where the primary strategy driver is the 530 put that I'm purchasing, and I'm going to sell that 470 put against it just to reduce my risk a little, reduce my overall outlay. I could potentially trade a few more contracts if I use a spread than I use an outright put. That's going to give me a little bit more leverage on this particular play. So that's really kind of where you're looking at. If just any stock that you have a bearish view on, you can take a tactical view like this using a put spread. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And we're going to bring this over to OptionsPlay here in a few minutes and show you, looking at this particular strategy, looking at risk to reward, looking at break-even prices so that you get a better sense for these overall strategies. But Jessica, any comments on buying a debit spread in general? Perhaps you can discuss a little bit about just rules that we typically have in place with respect to managing these trades. Where do you consider cutting losses when you buy a debit spread? Let's start with that. Where do you cut your losses when you buy a debit spread?
Yeah, so first and foremost, it is largely directional, and I do want to reiterate that. And you did say that November strikes, and I put this together, and I apologize, it's October that's on there, but I didn't write that, so that's on me. So I do want to make sure that's known, because I saw a lot of questions asking what expirations these were. So they're roughly about 30 days out. So do know that. But as far as risk management, that is extremely important and something we can talk about as well, and know that we pulled these and we want to talk about risk versus reward, and we talk about that quite a bit. But that's what OptionsPlay is designed to do, is to really mitigate the noise and make that as easy for you as possible. For debit spreads, we do like to cut those losses around 50%. And that's also on the profit side as well. So that's what's important with that trading mindset, is having those disciplined approaches as well, which we'll go into a little more detail when we pull up the tool. But I think that's important. And then the other note that I would like to add to this is that strategy driver, like Tony was talking about. This is a long put, and that's why we set up this slide this way. Is your trade is a long put. That's your beginner level options, if you will, and then you capping your gain potential by adding the short put at a lower strike, because it's not necessarily going to go to zero. It could, but if it goes below farther than your lower strike, you don't participate in anything else. And I think that's what's important to note here. And a little trick that someone taught me many moons ago when I was first trading options is the strategy driver is always the most expensive one in multi-leg options. So it's just a good little trick to watch there.
Right. So, and buying options is always going to be a bit of a challenge from the perspective of these types of strategies. In order for them to be profitable, the stock has to move. It has to move by quite a bit, and it has to move relatively quickly. And that's really, I would say, sometimes the challenge with these types of trades, because you can get the directional view right, but get the timing wrong. And that's what's difficult sometimes about buying a debit spread. It gives you the best risk to reward ratio for the least amount of risk, but yet it's a little tricky from a timing perspective. So the next strategy I want to talk about is something that gives you more of a looser directional view, but you don't really have to get that timing as critically. It comes with some trade-offs, but this is a strategy that is sometimes quite popular, especially during volatile times, because implied volatility is high. So this is what we call an income/high implied volatility strategy, where we're selling a call spread. In this particular case, same stock. What we're going to do is we're going to sell a 530 call option, so a call option that's slightly out of the money, and then what we're going to do is we're going to buy a 560 call option against it, well above that double top. And here the main strategy driver is that short call that we're selling. Now, if you were just to outright short a call option, one, you would require a fair amount of margin in order to do so. You need to have the options clearance to do so. Many of you may not necessarily do. And third of all, the reason that I do not recommend selling a naked call option is because you have unlimited risk. If the stock blows through that double top and starts running back up to 600 or so, you are truly at unlimited risk. Think about GameStop, think about AMC, those short traders, what they were risking to do so. You are effectively doing the same thing if you call option. So I do not recommend it. But there's a very easy way to prevent that. You can buy that out of the money call option for about $5. You're collecting $16 for the 530 call. If you pay another $5.50, you're going to limit your risk and significantly reduce the amount of capital required to get into this trade. In this particular case, it'll only cost you a little under $2,000 in order to execute one contract of this trade versus the tens of thousands of dollars it would take you to short the naked call, not to mention the high amount of risk. So this is a third strategy that you can utilize in a bear market strategy. And the benefit with the credit spread here is that the stock doesn't have to move lower in order for you to be profitable. You will be profitable if the stock moves lower, but you'll also be profitable if the stock just doesn't move. You will actually be profitable if the stock moves a little bit higher. So it's the only strategy that you can get the directional view somewhat wrong and still be profitable. Now, some investors might say, why doesn't everyone trade credit spreads? Well, sounds like I should be using credit spreads every single time. Well, the trade-off that you have with this higher probability of success trade is that your risk to reward is negative. So what you're risking is greater than what you can potentially make. That's the trade-off that you're making with these types of credit spreads. But very, very popular, and there are certain rules that you can put in place to try to protect yourself when using credit spreads. So Jessica, I think I know you want to move on to the next slide before we jump over to OptionsPlay. So let's talk a little bit about trading bear markets, and let's get back into OptionsPlay and start looking at some of these strategies.
Yeah, I think we can come back to this one, and it makes sense to go through the tool because I see a lot of questions on picking strikes, delta, implied volatility, and so that's naturally where we're going to take this. So let's go.
Okay, let's jump right into OptionsPlay. So I have a chart here of United Health up. And right now what we're going to do is we're going to focus our attention on bearish strategies and high implied volatility strategies for right now. So let's talk about that collar strategy first. And I think that this is suitable for any stock that you own, whether it's United Health, whether it's Apple, whether it's Amazon, that you think that you want to be a long-term investor in, but you're concerned about some downside moves in the short run. And this is really where we turn to that collar strategy that we were talking about here before. Now, there's a few different ways that you can look at this, but I think that the strategy that I was looking at before is that risk reversal, or what we typically would call a collar strategy. A collar strategy is typically the collar is referred to going long the stock, selling the call option and buying the put option. But if you were just selling the call and buying the put because you already own the stock, we typically call that what we call a risk reversal strategy. So before, I was looking at selling the 540 puts, 540 calls, and buying the 510 puts. And this one, as you can see, the trade cost is $137 credit. Remember, this is a $500 stock, $520 stock. So that's a $52,000 notional value contract. So 100 shares, $52,000. So you're collecting 137, which is virtually zero compared to the underlying stock. And this gives me, like I said, downside protection below 510. And if we look at a longer term chart here of United Health, 510 is all the way up here, near this top. What I'm protecting myself is anything below that. And I'm doing it for virtually zero cost, because what I'm doing is I'm selling off any gains above 540. If I sell my gains above 540, I can effectively buy this downside protection here for virtually free. And that's what we're trying to go for in a zero cost collar. But like I said, I don't think when you're using these types of strategies, zero cost should be the goal. The goal should be figure out technically where you think the stock's unlikely to go higher from, sell that call option, and then buy a put option where you think it's reasonable for you to want protection to the downside. Whatever that cost is, it's going to be the cost, but by selling that call option, you are reducing the cost of protection by a bit. I tend to find a lot of investors sometimes search for those zero cost collars, and many times they're never quite able to find the right one, or they're giving away way too much upside in exchange for not enough protection to the downside. So just making sure that you understand how to think about construction of a collar strategy for a stock that you might own. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. So that's why I chose the 540, 510, because it gives me a fair amount of protection. The only thing is, you have all these traders that are up here that are trapped, that I think could be at, our weak hands if things start to trade below those levels, and I'm willing to give up any gains above this kind of resistance level. And that's why I chose that 540, 510 risk reversal, which is really just a collar strategy on the stock that you might own. Okay, so you can apply the same type of strategy to any stock that you own. Apple, I think, is actually a good example of this too, Jessica. You were showing us today earlier that Apple recently just was rejected off the 200-day moving average. Let's put on that 200-day moving average. Sorry.
Respecting the moving average. Favorite term of the day.
Sorry?
Oh, I said respecting
okay.
respecting the moving average.
Respecting the moving average, right. So when I'm looking at Apple here, it's currently trading around 155. You have this 50-day moving average that it's currently looking like it's respecting around that 157, 160. I would look at, perhaps selling the 160 calls. In this particular case, I would look at selling maybe a November 160 call, and then I would try to buy protection perhaps below 150 or so. So let's say I add a put option. Sell the 160 calls, and then buy maybe a 150 put against it. In this particular case, it actually also happens to be very close to zero cost, but that's really more of a coincidence, in my opinion, rather than by design. So this just gives you a sense for how you can use OptionsPlay to look at, from a technical level perspective, where you would be willing to give up additional upside because it is now trading below that moving average, and what you are trying to protect it from to the downside, which could be well into the high 120s, which is where it traded back in mid-June. I'm concerned about a pullback into that 120, and I don't think it's going to go significantly higher above that 50-day moving average. That's how I would look at constructing a credit spread on a name like Apple. So let's go back to United Health, and let's now look at the bearish strategy. Well, one of the things that's neat about OptionsPlay is that it constructs these strategies that we've referred to automatically. So if we're looking at a debit spread, you can select the bearish strategy or a bearish outlook, and it will automatically construct that strategy that I was referring to before, that 530, 470 put vertical here. And what it's doing here, it's basically buying the slightly in the money call option and selling a slightly in the money put option, and then selling a put option that's roughly 1 standard deviation away. And if you look at this, what I'm doing is I'm paying $25 for the November 530 puts, and I'm collecting $6.70 for the 470 puts. So I'm reducing the overall cost of my trade by a little bit more than 20%. And that's really what the goal here of these types of strategies are, these debit spreads. They allow you to take that primary strategy driver, which is the 530 puts. That's what gives me that downside exposure, but it does so in a way with smaller amounts of risk. And when you reduce your overall risk, your returns are also amplified. And just to show you the two in comparison, this strategy in the middle, I'm just buying the put option for that $2,500. The strategy on the right-hand side is the put spread. So let's say United Health does start to pull back, and let's say it just pulls back modestly to, let's say, $500. Let's say it doesn't reach my 470 target, but it just reaches 500. If I bought the put option, I'm looking at about a 20% return on my capital. If I look at the put spread, I'm looking at a 63% return on my capital. That's the benefit that a put spread gives you in this type of market environment, that if you just use an outright put option, you're going to have a harder time to be profitable because of how much more you're risking and how much more capital it takes to get into the overall trade. Does that make sense, everyone? Why the put spread in this particular case might be better for you when you're trying to play for a downside move? Because of that reduced risk, you're able to have a higher return if you are right on your directional view. If that makes sense, please type 5 into the chat window. Perfect. And Jess, I think are you back?
Yep, I left my other laptop on. I'm so sorry.
No, you're totally fine. And then lastly, let's talk a little bit about, well, actually, one thing I do want to point out here is that when you look at a debit spread, right? This is the second strategy we're talking about. I'm risking $1,800. That's my max risk. My max reward is $4,165. So you have a very strong risk to reward ratio, but the probability of profit is only 41%, meaning the stock has to go below 511 before the strategy is profitable. The stock's trading about 526 right now. So the fact that this stock has to get below 511 before November expiration, from my perspective, that's not a whole lot of movement to the downside. That's only about $15 to the downside on a stock that moves quite a bit. You know, a $500 stock to move $15 between now and November, not a huge amount. And I'm getting a very strong risk to reward ratio. I'm risking 1,800 to make 41. That's over 2-to-1 risk to reward ratio. And I want to show you how that compares to the strategy that many investors love selling, which are credit spreads, because of that high probability of profit. But it's important to understand the trade-offs that you're making. Now, if you're interested in selling credit spreads, OptionsPlay also automates this strategy for you. You just simply click on the high implied volatility strategy, and you will have the bearish call spread on the right-hand side. You have both the bull put spread, which is a credit spread if you're bullish, but you also have the bear call spread, which is the credit spread if you're bearish. And we're going to look at the bearish one here today. And if you look at this, if I sold the 530, 560 call spread that I was showing you before, I'm going to, in this particular case, have a max reward of $1,100, but max risk of $1,800. So I'm risking about 1.5 times more than what I can potentially make. But the trade-off or the benefit is that I have a higher probability of profit, 63%. As long as the stock stays below 541, remember the stock's at 526. If the stock moves up by another $10, I'll still be profitable on the strategy. So I can be wrong in the direction and still make money. And a lot of people love that. But the trade-off is that you are going to risk more than what you can potentially make with this type of credit spread. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. Perfect. So that's how you can deploy these types of strategies on your portfolio. And the options play tool allows you to do it on any stock, not just United Health. So if you have a bearish view on Boeing, you simply type it in, and you can either, because you believe that there's going to be a quick and fast move to the downside, click on the bearish strategies and start to see the debit spread. It has the expiration date and strike price already built for you. You can use the P&L simulator to see how much potential gain or loss you might have if the stock goes higher, if it moves lower, and compare that to buying a put option if you're brand new to options, and compare the different strategies. Or if you have a little bit more experience and you're trading these credit spreads, click on the high implied volatility strategy, and now you'll be able to sell credit spreads. It's just important to understand the trade-offs that you're making with each one, debit or credit. Debit, remember, you need a quick and fast move, but you have a really strong risk-reward ratio. Credit spreads, you don't need to get the directional view quite right, or you can even have the timing completely wrong, but still be profitable. But if you are wrong, you're going to risk more than what you can potentially make. So those are the high-level things to really remember on these different strategies that you can deploy in these types of higher volatility, bearish markets for you to either protect your portfolio or take more of a strategic opportunistic approach to the current markets. So with that, I think now is a good time to turn back to that last slide and go over some of the things that you should keep in mind when you're deploying these types of strategies.
Yeah, I will attempt to share my screen.
And I can always do it if that fails. Nope. Looks like you got that up and running.
Great.
Jess, why don't you kick this off with the healthy trading mindset? Because I think this is important.
Yeah, so, and this is really a summation of everything that we covered when trading bear markets, and it's applicable to even bull markets, and know that there are also bear market rallies, in which case we can capitalize on as well. So that goes into that short-term and long-term view, if you will. But number one, healthy trading mindset, like I said before, risk taking. Anytime you make a decision, especially when your money is involved, should be calm, collected, and calculated. And that is a defined process. And you make sure it's a well evaluated and structured process, which is something that we've really worked hard on building to help you implement as well. But you also have to be in the mindset, and we cannot do that for you. So number one is ensuring that you're in that healthy trading mindset.
Yeah, and that's much easier said than done. But that's really where number 2 and number 3 come into mind, because in order for you to even have the opportunity to take trades in a bear market when you're most fearful of trading and investing, you're only able to really do that when you have a true understanding of the strategies that you're trading. And that's the purpose of these sessions here today, to make sure you understand these opportunities, what the trade-offs are. There's no perfect strategy. It's all about what the trade-offs of each strategy is going to be. And when we refer to options, I always get the question, which option is best? And the answer is there is no best option. It's a matter of where you want to sit on the risk spectrum. How much risk are you willing to take, and understanding what trade-offs you're making by taking on that kind of risk. So hopefully today gives you an idea of those two opposite ends of the spectrum. You can have a strong directional view and have a really good risk-reward ratio on that type of trade, but you need the stocks to move quickly. Or you can be on the other side and say, I'm not really good at timing the markets. I'm not really good at looking at the charts. So I'm going to defer to selling credit spreads, but understand that that comes with the trade-off of having a higher risk than what you can potentially make. One's not better than the other. It's just a matter of what's suitable for you based on your outlook. So today, hopefully that really conveys that to you and makes it clear. And you now see how you can use the OptionsPlay platform to deploy either one whenever you are ready to have a bearish opportunity. You can look at some of the bearish opportunities on the OptionsPlay platform, which I'll show you here in 1 second before we enter here. And then most importantly, a disciplined exit strategy. Now, I will say, the option strategies we discussed here today are all limited risk. So even if you don't have a disciplined exit strategy, the strategies themselves effectively limit your risk to the downside and cap your potential upside. So you don't need to have it, but it is good to also think about cutting losses perhaps sooner before you lose 100% of the premium so that you can protect some of your capital when a trade's not working out. But I will say less important if you are using some of these strategies that we're deploying here today. So with that, what I do want to spend is just 2 minutes showing you some of the tools that we've recently launched into the OptionsPlay platform that help you find opportunities. You have our trade ideas section. You can filter trade ideas simply by bearish ideas if you're looking for them. And you can also do it based on, you can also filter based on IV rank and liquidity. So perhaps you want to filter out options that are not liquid and have lower IV rank, and you can apply that and see what opportunities there are. In this particular case, I don't see any for today, but let's take a look at perhaps if we're, actually, hold on. We have all scans selected. Okay, so here we have 7 names here. Now, right now, none of them are particularly liquid. So that's one way to potentially look for opportunities. But we also have a bearish momentum watch list. So if you look at the watch list section, we've built a bunch of watch lists and you have a bearish momentum watch list. That's another way you can look for some bearish opportunities. These are 2 different ways that you can scan for opportunities. And we've recently added both the IV rank and liquidity filter to our trade idea section. This is great. These are great ways to scan for opportunities in the market, like I found for United Health using these types of scans. So that's something that I wanted to show you here before we turn this over for Q&A during today's session. So while we do that, what I'm going to do is I'm going to ask everyone, if you have any questions, feel free to type your questions into the Q&A window. But in the meantime, for those of you that are joining OptionsPlay here for the first time, there's a lot that we offer here that we showed you here. The OptionsPlay platform, sessions that Jessica and I host here today to help you master your process and learn more about these option strategies and best practices so that you know how to apply them properly. Access to the OptionsPlay platform so you can find these strategies, analyze them, and make sure you understand them before you execute. And most importantly, helping you also time the markets, know when markets are turning bearish, when they're about to turn bullish. Rick Benson, our chief market strategist, provides a weekly overview of the broader market so that you have that compass to guide you as to when you want to look for more bearish opportunities, when do you want to start looking for bullish opportunities. So all 3 are part of the OptionsPlay experience that you get as part of your free 30-day trial at optionsplay.com. So if you're joining us for the first time, please consider signing up for that 30-day trial. It's going to give you access to everything. You don't need to put in your credit card. Try us out. And if you choose to subscribe afterwards, I hope that you do, because these are tools that we use every single day to help us understand the directional view of the markets and how to find opportunities. So with that, let's try to answer some questions. Like I said, there's a Q&A section and a chat window section. Please type your questions in the Q&A window and we'll try to answer a few questions before we sign off for today.
And I do see a lot of questions about replay that will be available shortly after, or a few hours after rather. If you registered, you'll automatically get it in your email as well as a link to today's slides.
So Jess, feel free to pick out any questions that you want to answer, but I'll take the first one here. And this is a good question saying, what should I do if I have a lot of bearish positions and there's a bear run? I think what you mean by a bear run is a bear market rally. That's like saying, what do you do in a bear market when you're a long only investor? If you still believe in the bearish market, you should stick with your trades. You might have to reposition your trades to buy yourself more time based on the bear run. But if you believe that things are still bearish, this is your opportunity to take advantage of it. So you might have to cut some losses on some trades that you got the timing wrong on, but that doesn't change overall strategy, because that's the same advice that I give to someone who's a long only investor during a bull market, during a bear market. Bear markets are opportunities to buy at a lower price. And if you're a bear and you start to see a rally, those are opportunities to short at a better price. But that is only true if you continue to believe in that bear market. Kevin's asking, how do you hedge your portfolio with S&P futures? Well, futures hedging is about as easy as it possibly gets. You just short the future and that's it. There's nothing else more to it than that. The question is just how much do you want to hedge and how long do you want to hedge for? But the actual mechanics of hedging could not be simpler.
Mm-hmm.
William's asking, do you trade more debit spreads or more credit spreads? I seem to have a better ROI with credit spreads. Then stick to credit spreads. Here's the thing, is that debit spreads are only suitable for very specific market environments that don't come along that often. You're going to find far more opportunities to sell credit spreads than you are going to trade debit spreads. So for that reason, people tend to sell credit spreads more than they buy debit spreads. Joe is saying, to hedge your stock, why not? Sorry. Last one, I promise, and I'll let you answer one. Joe's asking, to hedge your stock, why not sell calls and use a stop limit on the stock? You absolutely can, but the problem is then that you've now sold your stock at a lower price, and if the stock now recovers, you're no longer participating on it. Using the strategy that we're talking about here, you still have participation in the stock. If you own the stock that pays dividends, you'll still continue to collect dividends on that stock. So those are the reasons why you might want to use a collar strategy rather than a stop limit on your stock.
I hope my Wi-Fi is better, so I apologize if I've been in and out. But I did see a wonderful question on understanding the basic option strategies and those 4 foundational ones. We've got 2 really great videos out there, and we build it in a congruent order, if you will, on our YouTube channel. But start with the options pricing video and then understanding calls inputs. We built those so you get the foundational elements really well. It is about 2 hours of content, but there is an agenda in those so you can scroll through and pause and rewind when applicable.
Thank you. Gary's saying, can you discuss the importance of patience with these trades? I took the Boeing trade, saw it was going the wrong way and exited after 2 days, but now I see it's reversed and it was a great trade. Gary, a great question on managing emotions. And the one thing I will say is that it's difficult to manage emotions when you are truly exposed. But that's why we use options to place these trades. Meaning, even if Boeing went all the way back up to $300, where it was a few years ago, when you use an option strategy like this, you've already defined your risk. So no matter what happens, even if the stock goes back to 300, you know what you're risking. That's one way that you can stick to trades. You know, no matter what happens, I'm comfortable with the risk, right? That allows you to stay in a trade, even to suffer through some of the short-term pain to potentially take advantage of the potential profit in the future. But ultimately, at some point, you may find yourself making that decision to pull the plug early, and then after you pull the plug, the stock goes in your favor. But that's why we have rules in place. We say that once you buy a put or a call or a debit spread and it's lost 50% of what you've paid, it's time to get out. We have those rules because once you've lost 50% on an option that you've paid for, your chances of getting back to break even are relatively slim, only about 15 to 20%. So I'd rather save the other 50% than, and then lose the other 50% in 80% of the time. So ultimately, you're never going to be able to get the best possible outcome on every single trade. You just have to draw the line somewhere. And I do find that it's easier when you're trading limited risk strategies.
Absolutely. And on those longer options, just to add to that, because it's such beautifully said, time is working against you. So if you've hit the point of your 50% loss, the likelihood of the time's not going to come back. So now you need even more directional movement to be profitable, which alludes to the reason why there is low probability of success at that point.
Right. And Winston's asking a great question. How much capital do you recommend for these bear market strategies? So Winston, whether you're trading in a bull or bear market, how much capital you commit to a trade should not change. You shouldn't be risking more or less because it's a bear market. You should never risk, in my opinion, more than 2% of your overall portfolio. So one of the things that we did recently add to our tool is a portfolio calculator, meaning a risk and investment calculator based on your portfolio size. So for any strategy you're looking at on OptionsPlay, if you click on the risk and investment calculator, which is underneath your 3 strategies, within the risk and investment calculator, you can now set the default in your profile. Now, I have set my default to risk no more than 2% of my $100,000 portfolio. I recently hosted a session about a month and a half ago on why these rules are so important, why this 2% rule is so important. I recommend that you don't go more than 2%, but you enter your own portfolio value. So if you have a $50,000 portfolio or whatever you have in your portfolio, you enter that and save it as default. And when you do so, anytime you place a trade, all you have to do is click on the calculate button, because it automatically applies the $2,000 risk that I am willing to take in my portfolio. So this is customized to you. 2% of $100,000 is $2,000. So when I click on calculate, it'll automatically calculate the number of contracts or the amount of capital that you need to commit to your trade. This is one of the most important tools, arguably more important than anything we taught you here today, is making sure that any single trade you take, no matter bullish, bearish, whatever, doesn't blow up your account. And you can do so by managing your risk. It's the only way to prevent yourself from blowing up your account. How many of you have used this specific feature in OptionsPlay? Type yes into the chat window if you have used this one specific feature, and type no if you have not. If you haven't used this feature yet, type no. If you have, type yes. And I'm really happy to hear there are a lot of yeses here, but I still see quite a few no's. So after you finish here today, highly, highly recommend go to your risk and investment calculator. You only have to do this once, or do it if the value of your portfolio changes significantly. Click on adjusting your portfolio default. Type in what your portfolio value is. My suggestion is you stick to the 2% that's already put in there for you, and click on the calculate button every single time you place a trade, because it'll automatically calculate for you how many contracts you should trade to keep you in your lane, and making sure that you are very unlikely to blow up your portfolio if every single time you place your trade, you stick to these rules. And if you want to go back to that session that I hosted on how to profit as a trader, these are the rules that you have to have in place. You can only profit if you don't blow up your account. If you blow up your account, you have no shot at profiting. You only have a shot at profiting if you don't blow up your account. And these are some of the rules for you to go about doing so. We'll answer one last question before we jump off here, because we are now at the 1 hour mark. And Jess, I will hand this last one to you. So dealer's choice.
Oh, dealer's choice. I'm terrified due to my Wi-Fi right now, but sure thing.
If you need, I'm happy to step in. But
thank you for that, Tony. I like this one from Frank. What are the green, red bricks on your charts? That is the trend. So essentially, you'll notice that there's a lot of indications of trend, but we wanted to show it over time. So as Tony's showing at the bottom there. So part of what we try to do at OptionsPlay, or what we do at OptionsPlay, is it's set up to give you ideas with that first panel. And then once you have your idea, you want to verify your sentiment. So that's the purpose of those bricks, if you will, or blocks. It's an indication of trend.
Yeah, that's exactly right. It's basically showing, it's really showing you the overall trend of the stock. So if the stock is trending lower, it turns red. If it's starting to turn higher, it turns green. So it helps you stick with the overall trend. So it's, short-term noise doesn't shake you out of a trade. Notice how the 6-month trend remained bearish this entire time. Someone else was asking, how do you stay bearish in a bear run? These types of trend indicators can help you do that. It helps you understand, okay, only the short-term trend has turned higher here, but the long-term trend remains bearish. And as soon as they both turn bearish here, right here, that was potential an opportunity to continue to seek some further short exposure here. We have a similar type position here recently where both trends turned bearish. And when you see rallies in these types of markets, those are opportunities to seek some further downside. So with that, thank you so much for your time here today. Once again, I hope that you guys find this useful in giving you a better understanding of how to navigate these markets when things turn volatile, when things turn emotionally very difficult. That history lesson giving you a bit of understanding is that these are tough times to trade, but hopefully today gives you some of the tools that you need to better navigate during this. And if you haven't tried out OptionsPlay yet, or the platform, the education, or some of our macro sessions to give you an idea from timing the markets, you can join us for free for 30 days at OptionsPlay.com, or you can point your phone at that QR code in the corner to sign yourself up for that 30-day trial. So with that, thank you so much. Thank you, Jessica. And I will see both of you, all of you guys, next week on our next Monday macro session that I will be hosting while Rick is on vacation. Thank you so much and have a great evening.
Thanks, everyone.